Welcome again, VITA volunteers. We are back with another advanced topic. In the basic trainings, we covered 4 common adjustments to income for educator expenses, for penalties paid to banks for early withdrawals on things like CDs, for alimony paid in accordance with pre-2019 divorce decrees, and for student loan interest. In this lesson, we will expand our repertoire to include 4 more adjustments, including for self-employment tax, self-employed health insurance, contributions to IRAs, remember individual retirement accounts, and contributions to HSAs, health savings accounts. So our self-employment tax and adjustment and our self-employed health insurance deduction occur on returns where we will have a Schedule C, which again we just covered in our business income lesson. And when somebody comes in with this type of return, we'll notice on their intake form, Form 13614C, on page 2 in the income section, they'll be checking yes to having self-employment income or possibly some other income, cash or check or other property or services received for work that they performed that wasn't reported to them on either a W-2 or a 1099. And then in particular for the self-employed health insurance deduction, we would also be noticing in that expenses section that they're saying, yeah, I have some medical and dental expenses, including insurance and premiums. And then, of course, a little further down, we just have blanket expenses related to self-employment income or other income that you received. So these are the boxes that we would expect to be checked that will cue us that we might be looking at these types of adjustments. When our self-employed taxpayers have calculated, or the software calculated for them, their net profit or loss on Schedule C, if they had $400 or more of profit, they will need to pay the self-employment tax, half of which may be deducted as an adjustment to net income. The self-employment taxes are really just Social Security and Medicare taxes. If our taxpayer had earned this income as an employee, the employer would have deducted half of these taxes from the taxpayer's wages and remitted the amounts to the IRS, as well as paid the other half, the employer portion. Because our taxpayer is self-employed, this process did not take place, and the taxpayer will need to pay both the employer and the employee portion of the tax. If an employer had paid their portion of these taxes, that employer would have been able to deduct those amounts from the business income reported for income tax purposes. To keep things fair for self-employed individuals, they are permitted an adjustment to income of half of the self-employment tax, what would be considered the employer's portion. Note on Schedule SE, that's SE for self-employment, where the self-employment tax and the accompanying adjustment is calculated, that neither the tax nor the adjustment flow back onto Schedule C. Instead, the tax flows through Schedule 2, other taxes, before making its way onto the 1040 in the taxes section, and the adjustment flows through Schedule 1, eventually making its way onto the 1040 on the adjustments line. You might also note that on line 7, there is a cap on income that is subject to the Social Security tax. This amount adjusts year to year based on inflation. For the purposes of this lesson, we're not going to go through the flow through of Schedule 2 for the other taxes, and we're just going to focus here on Schedule 1, which is our other income and adjustments to income. And so you can see here on line 15, that's where we have the deductible part of the self-employment tax flowing from Schedule SE. And then our next line of interest is the self-employed health insurance deduction. And so that's where our self-employed individuals will get to deduct or may get to deduct some or all of their self-employed health insurance costs. Because again, an employee, if they are purchasing health insurance, or if their employer is paying for health insurance for that person, then that the cost of that insurance is not included in that employee's income. And so again, keeping a level playing field as much as possible between our self-employed individuals and employees, we're going to allow the self-employed individuals to have an adjustment to their income. Now there are some limits on how much a taxpayer can take for the self-employed health insurance deduction. So first of all, they have to report a net profit from their trade or business on their Schedule C. Otherwise, they wouldn't be able to take this. They can't use this deduction to create an even bigger loss. And then they can't take any more than the earned income from that trade or business. So even if they did report a profit, they would be limited to the amount of that profit, and the profit must specifically be earned income. So the way that we calculate the limit is the self-employment profit on the return, and then we subtract out half of the self-employment tax. Remember, that's the same amount that we took as an adjustment. And the difference there is the limit that the taxpayer is allowed to take of self-employed health insurance deduction. Now, if they can't take the full amount as a self-employed health insurance deduction, it may be possible that they could deduct the remainder on Schedule A as an itemized deduction. And in a later lesson, we'll learn a little bit more about Schedule A and itemized deductions. And there are a few more rules regarding the self-employed health insurance deduction. We're limited on the types of insurance that can be claimed for this, and who it can cover, and then of course it has to be established under the trade or business, and we'll talk about that. So the types of insurance that qualify for this deduction would be regular old health insurance, dental insurance, vision. It could be a supplemental insurance plan, a limited coverage insurance plan. It could be for long-term care, although there are some extra limits to that, and we'll go over those a little bit more in, again, the itemized deduction lesson. And it could also be for voluntary Medicare payments. As far as people that this plan can cover, it can be the taxpayer. It can be the taxpayer's spouse if they're married filing jointly. It could be a dependent, and it could also be a child who is under 27 but not a dependent still. And then as far as established under the trade or business, what that means is it would be under the taxpayer's name. It could be under the spouse's name, again, if they're married filing jointly, or it could be under the business's name. Now, if any one of those people that we talked about before that could be covered under this plan, the taxpayer, the spouse, the dependent, the child under 27, if they are eligible to be covered through their employer in a subsidized plan, the taxpayer is not able to deduct the cost of the insurance paid for that person. So that's calculated on a monthly basis. So if in some months the child under 27 had another job and they could have gotten insurance through their employer, then the cost of their health insurance paid by our taxpayer would not be able to be deducted from the taxpayer's income. And then a scope issue with this is that if we have somebody who was insured through the marketplace, remember our Obamacare plans, if they were insured through the marketplace and they qualify for the premium tax credit, that is a return that we will need to send somebody to a paid preparer to assist with. So that kind of wraps up for this lesson, our self-employment kind of topics. Then we have a couple of adjustments that have to do with special tax favored accounts. So we have HSAs, which are health savings accounts, and we have IRAs or individual retirement arrangements. Both of those are tax favored accounts, and if our taxpayers contributed to them, they may be able to take an adjustment. If we go back to our form, our Schedule 1, we can see here where those adjustments show up. Line 13 is for the health savings account deduction, and you can see that flows from another form, Form 8889, which we'll look at. And then line 20 is for the IRA deduction. So again, our health savings account is a tax-favored account. It's a very tax-favored account. The contributions to that account are not taxable as long as they are within the limits. The earnings on the money in that account they are not taxable as long as they are kept in the account, or if they are distributed for unreimbursed qualified medical expenses. Unused funds can carry over from year to year with no limit. Earnings carry over from year to year with no limit. So you could see if this type of account were to be contributed to like as if it were a retirement account, and the funds were invested, that this could be an account that could build up quite well over time. And again, distributions are not taxable if used for unreimbursed qualified medical expenses. So what little bit we talked about IRAs, especially traditional IRAs, remember if the distributions are taken, then the earnings are taxed. And so this is kind of a double haven. It's not taxed going in, it's not taxed coming out, so long as the rules are followed. To be eligible for a health savings account, our taxpayer will need to be covered by a high deductible health plan on the first day of any month that they are contributing to this account. Again, this is figured on a monthly basis, not a yearly basis. They can't be covered by any other health insurance. There's a little additional information in publication 969 on some exceptions to that. They would not be enrolled in Medicare. The individual can be HSA eligible for the months being covered by Medicare. And they cannot be eligible to be claimed as a dependent on someone else's tax return. As promised, here's our Form 8889 for health savings accounts, and you can see it's divided into 3 parts. Part 1 is where it calculates the contributions and the deduction. Part 2 figures any taxable distributions and if there were penalties involved. There's an additional 20% tax if distributions are taken for non-qualified expenses. And Part 3 calculates the penalty if the individual had the wrong type of health plan. This account can be held by someone with a non-high deductible health plan, but they cannot contribute to it unless they have the high deductible health plan. So there's an important distinction there. And there are many different ways that money can get contributed to these accounts. Some of them will result in an adjustment and some of them will not. So an individual may make a contribution on their own. They could receive contributions from family members or really anyone else. And those types of contributions would end up as an adjustment on the return. However, if the contribution was made by an employer or the employee through their employer, there would not be an adjustment on the return because the employer already decreased the amount of income that they reported in box 1 of the W-2. And we recognize this kind of situation because on the W-2 in box 12, there will be a code W with the amount next to it that was contributed to the health savings account. A form that some of our taxpayers may come in with is this 5498 SA. This is an informational form that shows the contributions made into the HSA. Most often, for our clients, contributions into the HSA were either made by the employer or by the employee through their employer. So the total amount of contributions shows up on the W-2 box 12 under code W. In which case, we might just check to see that those amounts are the same as what is reported on this form, but this form is not required to be input into the return. So often we can just return this to the taxpayer. Also, if the taxpayer does not bring the form in, we do not need to have it in order to file the return. Where this form can be useful is in situations where the taxpayer is unsure whether or how much they made in additional contributions to their HSA. In which case, we can subtract the total contributions from W-2 box 12 from the amount on the 5498 SA box 2 to figure the amount of contributions that might be deductible as an adjustment to income. As I talked about before, HSAs are highly tax-favored accounts, so of course there are going to be some contribution limits. These limits are inflation adjusted, so you can expect them to change from year to year. You will also note that the limits depend on whether the eligible individual had self-only coverage or family coverage, which is twice the individual contribution amount. Taxpayers over the age of 55 are allowed an additional catch-up contribution. Allowable contributions are prorated on a monthly basis, so taxpayers may have lower contribution limits if they switch to or from a high deductible health plan during the tax year. It is also important to note that even though a taxpayer may have family coverage, these accounts are owned individually, so contributions and distributions are reported separately, where each spouse in a married filing joint situation had their own HSA. These two situations can be a little bit more complex, so if needed, look up Publication 969 for more information on contribution limits. So that's the contribution side. Now let's look at the distribution side, when money is taken out. In order to not trigger any taxes or penalties, distributions must be used to cover unreimbursed qualified medical expenses. It does matter who these expenses are paid for. It must be for the taxpayer, the spouse, or the dependent at the time the expense was incurred. So for instance, if in December a certain person was a dependent and went to the doctor, but then was not a dependent in the next year when the bill was paid, the distribution would still be tax-free. And regardless of if the plan was for self-only or family, distributions are tax-free for anyone on the return. So then we look at what kind of expenses qualify. These could be fees paid for doctor visits, dentists, and hospital-related expenses. They could be for medical equipment, supplies, or diagnostic devices or services. But they must be primarily to alleviate or prevent physical or mental disability or illness. So cosmetic treatment generally does not qualify, and neither do general wellness expenses such as vitamins or gym memberships. With the CARES Act, however, qualifying expenses do include menstrual care items and over-the-counter medications. For a more complete list, you can look in publications 969 and 502. And then our taxpayers who had distributions from these accounts will come in with, or should come in, with a 1099 SA. And that will have in box 1 a gross distribution amount, and then there are some codes associated with this. A code 1 is a normal distribution in this case. And this is an important form to have reported on the tax return, so this is one that is needed. So on to IRAs. Now, if you remember back to our basic lessons on retirement income, we talked about some different kinds of IRAs. There's traditional IRAs and there's Roth IRAs. And traditional IRAs, the contributions may be deductible as an adjustment to income. Roth IRAs, however, that's not the case. The contributions are not deductible. So again, with a tax-favored account, we're going to have some contribution limits. And some of those contribution limits are that the taxpayer cannot contribute more into a retirement account, an IRA, than they received in compensation. And that might be wages, that might be business income, could be a number of places that they're getting income as compensation or earned income. And the contribution limit or the deductible limit is the lesser of the contributions or the general limit reduced by Roth contributions. So the rule with IRAs is it doesn't matter how many IRAs you have, there's going to be a general limit that changes each year, just similar to the HSAs. But it doesn't matter how many accounts you have, there's a global limit to how much you can put, regardless of whether it's a traditional IRA or a Roth IRA. And here you can see the global limit for this year. And just as there was an additional amount based on age for HSAs, you can see that the global limit for IRAs is higher for taxpayers over a certain age. Like HSAs as well, IRAs are not owned jointly for spouses. Each spouse will have their own accounts in their own names. Unlike HSAs, the contribution limits apply to each spouse individually. Now that global contribution limit can get a little more complicated. There are phase outs, and those phase outs are based on a modified adjusted gross income and whether the taxpayer or the spouse is covered by a retirement plan at work. I took a table here from publication 590A. It is not the only table associated with this. Generally speaking, for the type of clients that we're going to be seeing, we're not going to be seeing a lot of phase outs, but just so that you know, if we have taxpayers who are covered by a retirement plan at work, it's possible that there could be limits to the amount of deduction they could take. And then as far as timing contributions, there used to be an upper limit on the age you could be and still contribute to an IRA. That was gotten rid of by the Secure Act, so even older people who are retired could technically still be contributing to their IRAs. And then the taxpayer has up to the original due date of the return. So even if, you know, December 31st has passed and they haven't made a retirement contribution, but they intend to make a contribution before the due date of the return, so April 18th for this year, then they would be able to deduct that on their return. And that's not a completely uncommon strategy. A lot of times taxpayers want to wait and see what their tax will be, or their tax is going to be a little higher than they thought, and so they decide to lower the amount of tax by making a contribution to an IRA. And then they have up to the original due date of that return. So, and lastly, as we talked about, there are limits to how much of a contribution could be deducted, or there may be excess contributions that weren't allowed. These situations would require Form 8606, which is out of scope for us. So if we're looking at somebody who is made some non-deductible contributions, then they will have basis in their IRA. They need to see a paid preparer to help with that. And with the excess contributions, there can be a tax associated with that, an extra tax, which we'll talk about in a later lesson. But if they're going to have that tax, then that return would also be out of scope.